How to start investing in 2026, even if you're starting from $100. Part 1. Intro. Imagine waking up 10 years from today. You check your investment account before work. Instead of seeing just a paycheck, you see thousands of dollars that grew while you were sleeping. No lottery, no crypto miracle, no secret stock picks. Just a simple investing system that millions of wealthy Americans have quietly followed for decades. Now, imagine the opposite. You work hard every day. Your savings sit in a bank account, earning almost nothing. Inflation quietly steals your purchasing power. And 10 years later, you realize you worked just as hard, but ended up much further behind. The scary part? Most people don't make the wrong investment. They never invest at all. Today, I'm going to show you exactly how complete beginners can start investing the smart way, not gambling, not day trading, not chasing meme stocks, just a proven strategy that has helped ordinary people build extraordinary wealth over time. And by the end of this video, you'll know how to choose a platform, what account to open, how to build your first portfolio, and why investing can be much simpler than Wall Street wants you to believe. Let's begin. Chapter 1. Meet Jake. Meet Jake. He's 26 years old. He lives in Austin, Texas. He has a steady job earning around $65,000 a year. Every month he tells himself, this is the month I'll finally start investing. But somehow he never does. One week he's worried about a recession. The next week, he hears someone claim artificial intelligence stocks are in a bubble. Then another influencer insists Bitcoin is the only investment anyone should own. Every opinion sounds convincing. Every headline feels urgent. So Jake does what millions of beginners do, nothing. His money sits in a checking account, safe, but slowly losing value. Then one evening, Jake meets his neighbor, David. David isn't flashy. He doesn't drive a Lamborghini. He doesn't post screenshots of million-dollar trades. But something about his life stands out. He never seems stressed about money. When Jake asks for his secret, David smiles. There isn't one. I've been investing every month for almost 15 years. Jake laughs. That's it? David nods. The hardest part wasn't investing. It was getting started. That conversation changes everything, because Jake realizes something important. The people becoming wealthy aren't necessarily smarter. They're simply getting started earlier. Chapter 2. The first big decision. The next morning, Jake decides today is different. He's finally going to open an investment account. Then reality hits. He searches online. Hundreds of investing platforms appear. Each one promises to be the best. Lowest fees, fastest growth, expert recommendations, bonus cash, free trades. It's overwhelming. Many beginners make the mistake of choosing a platform because of flashy advertising. But experienced investors look at something else entirely. Trust. Before you invest a single dollar, ask one question. If this company disappeared tomorrow, what would happen to my investments? That's why regulation matters. In the United States, reputable brokerages are overseen by financial regulators, and many also provide protections for customer accounts under established rules. While these protections don't shield you from market losses, they help safeguard customer assets if the brokerage itself fails. Another factor? Fees. Imagine paying just 1% more every year than necessary. It doesn't sound like much, but over 30 years, That small percentage could reduce your final wealth by tens or even hundreds of thousands of dollars, depending on how much you've invested. The wealthy understand something most beginners ignore. Every dollar saved on unnecessary fees stays invested and keeps compounding. Chapter 3. Simple beats complicated. Jake expected investing to feel complicated. Instead, David gave him surprising advice. Pick a platform you'll actually use. That's it. Not the one with the fanciest app, not the one with celebrity endorsements, the one you'll trust enough to keep investing in every month. Because here's the truth. The platform isn't what makes people rich. Consistency does. Think about a gym membership. The most expensive gym won't make you fit. Showing up every week will. Investing works exactly the same way. Successful investors aren't constantly changing platforms. They're consistently adding money. Month after month, year after year, market up, market down. They keep going. Chapter 4. Why most beginners fail before they even start. Jake almost made one huge mistake. He opened social media. One creator claimed he'd turned $5,000 into $500,000. Another promised daily profits. Another said traditional investing was dead. For a moment, not which stock to buy, but which type of investment account could legally help him keep more of his money instead of paying unnecessary taxes. Because earning money is important, but keeping it is how real wealth is built. End of part 1. How to start investing in 2026, even if you're starting with $100. Part 2. Chapter 5. The account that can save you thousands. The next day. Jake sat down with David again. His investment account was almost ready. He had one final question. So, what should I buy first? David smiled. You're asking the wrong question. Jake looked confused. The first thing you should choose isn't a stock. It's the type of account. Jake frowned. Does it really matter? David nodded. It matters more than most people realize. Imagine two friends. Both invest exactly the same amount. Both earn the same average annual return. Both stay invested for 30 years, but one of them pays unnecessary taxes every time they earn dividends or sell investments. The other uses a tax-advantaged retirement account, following the rules that apply to that account. By retirement, they may have dramatically different amounts of money, not because one picked better investments, but because one kept more of what they earned. That's why choosing the right account can be just as important as choosing the right investments. For many Americans, accounts such as a Roth 4RA, a traditional IRA, or a 401k, when available and appropriate for their situation, can offer significant tax advantages. Exactly which account is best depends on factors like your income, employer benefits, eligibility, and long-term goals. Jake had never thought about taxes. Like most beginners, he only thought about making money. David explained something that changed Jake's perspective forever. It's not just about how much you earn, it's about how much you keep. Chapter 6. The Trap That Looks Exciting. After setting up his account, Jake started exploring the app. He noticed another section: trade options, margin, leveraged ETFs, advanced trading features. Everything looked exciting. One tap, huge potential gains, fast profits. It felt like a shortcut. But David immediately stopped him. Stay away from things you don't fully understand. Jake laughed. But everyone online says this is where the real money is. David asked, and how many of those people show you their losses? Jake stayed quiet. Social media often celebrates winning trades. Very few people post the months or years when they lose money. That's why long-term investors focus on building wealth steadily instead of trying to get rich overnight. Investing and speculation are not the same thing. Speculation depends on guessing what happens next. Investing depends on owning productive businesses and giving them time to grow. One approach creates excitement. The other has historically built lasting wealth for many patient investors. Jake made his decision. He closed the advanced trading screen. He wasn't looking for excitement. He was building a future. Chapter 7. Stop looking for the next apple. That evening, Jake searched YouTube again. Every video promised the next big winner, the next Nvidia, the next Amazon, the next Tesla. Everyone seemed certain. David laughed. Do you know what all those videos have in common? Jake shook his head. They're all made after those companies already became successful. No one can consistently predict the next superstar stock. Even professional fund managers often struggle to outperform the broader market over long periods. David continued. You don't need to find the next Apple. You can simply own Apple and thousands of other companies at the same time. Jake looked surprised. You can do that? David smiled. That's exactly what broad index funds are designed to do. Instead of betting your future on one company, you spread your investment across many companies. If one struggles, others may continue growing. That's diversification, not because it guarantees profits, but because it helps reduce the impact of any single company performing poorly. Chapter 8. The Three-Fund Portfolio. David opened a notebook. He drew 3 simple circles. This is the strategy many long-term investors use. The first circle. U.S. Stock Index Fund. This gives exposure to many of America's largest companies across different industries: technology, healthcare, finance, consumer goods, industrial businesses, all working for you. The second circle. International Stock Index Fund. Because opportunity doesn't stop at America's borders, businesses in Europe, Asia, Canada, Australia, and many other regions can also contribute to long-term growth. The third circle. Bond Fund. Jake frowned. Bonds sound boring. David smiled. They are. And that's exactly the point. When stock markets become volatile, high-quality bonds can help reduce overall portfolio swings, though they also carry risks and their value can fluctuate. Think of stocks as your engine. Think of bonds as your seatbelt. Both have different jobs. Chapter 9. Building Jake's Portfolio. Jake asked the question every beginner asks. So, how much should I put into each one? David explained there isn't a single perfect answer. It depends on your age, your goals, your ability to handle market ups and downs, and how long your money can stay invested. Someone with decades before retirement might choose a portfolio with a larger allocation to stocks. Someone approaching retirement may prefer a higher allocation to bonds to reduce volatility. The important thing isn't finding the perfect percentage, it's creating a diversified plan you can stick with through good markets and bad. Jake looked at his screen. For the first time, investing no longer felt confusing. It felt logical, simple, and achievable. But David wasn't finished. Choosing investments is only half the battle. The real secret is making sure you keep investing even when life gets busy. In the next part, Jake discovers the power of automation, why investing every month often beats trying to time the market, how compound growth can quietly transform small monthly contributions, and the 3 situations where selling an investment might actually make sense. End of Part 2. Part 3. Chapter 10. The secret most millionaires never talk about a week later. Jake had done everything right. He chose a trusted brokerage. He opened the right type of investment account for his situation. He built a diversified portfolio. Now he faced one final question. How do I make sure I never stop investing? David smiled. The answer is simple. Remove yourself from the process. Jake looked confused. What do you mean? David picked up his phone. Every month, before you even think about spending your paycheck, schedule an automatic investment. Pay your future self first. Jake had always paid everyone else first. Rent, utilities, car payment, streaming subscriptions, restaurants, whatever was left over, went into savings, or more often, nowhere. David explained something Jake had never heard before. People don't usually fail because they don't earn enough. They fail because they only invest what's left, and there's rarely anything left. So Jake set up an automatic monthly investment. Not $1,000, not $500, just $200 every month. An amount he knew he could continue regardless of what the market did. It wasn't exciting, it wasn't dramatic, but it was sustainable. And sustainable habits are what create long-term wealth. Chapter 11. The Snowball That Never Stops Growing. 3 months later. Jake logged into his account. The market had dropped. His portfolio was down. His first reaction was panic. I knew this would happen. David laughed. No, this is exactly what was supposed to happen. Jake stared at him. What? David picked up a snowball. Imagine pushing this down a hill. When it's small, it barely moves, but every rotation adds more snow. It becomes larger, then heavier, then unstoppable. Compound growth works the same way. Your first few years may not look impressive. The gains seem small. Some months your account grows. Some months it falls. But every contribution buys more investments. Every dividend can be reinvested. And over many years, those gains have the opportunity to generate gains of their own. That's why time is often considered one of an investor's greatest advantages. The earlier you start, the more opportunity your money has to grow. Chapter 12. Stop watching the market. Every day, Jake developed a bad habit. Every morning, before brushing his teeth, he checked stock prices every lunch break. He checked again, before bed. One more time. His emotions rose and fell with every market move. Green day, he felt like a genius. Red day, he questioned everything. David finally said, "You don't dig up a tree every morning to see if the roots are growing. You plant it, you water it, and you give it time." The stock market is similar. Daily price movements often reflect short-term news and changing sentiment. Long-term investors focus more on years than days. The greatest investors understand something many beginners forget. Patience isn't waiting while doing nothing. Patience is sticking to your plan even when emotions tell you to abandon it. Chapter 13. When should you actually sell? Jake finally asked the question every investor asks sooner or later. So, when do I sell? David became serious, not because the market drops, not because a headline scares you, not because your neighbor says a crash is coming. There are a few situations where selling can make sense. First, your original reason for owning an investment has changed. Maybe the company has experienced major leadership problems. Maybe its business model is no longer competitive, or perhaps there are serious accounting or governance concerns. Second, you genuinely need the money for a higher priority goal, a down payment on a home, starting a business, paying for education. Those decisions depend on your personal financial plan. Third, your portfolio has drifted too far from your intended allocation. If one asset grows much faster than the others, some investors periodically rebalance to bring their portfolio back in line with their target mix. David paused. The biggest mistake? Selling because you're emotional. Fear and excitement are both temporary. Your long-term plan should be stronger than either one. Chapter 14, 10 years later. Fast forward. 10 years. Jake wasn't a millionaire, at least not yet, but something remarkable had happened. Every month, without thinking, money continued flowing into his investments. Some years were incredible, others were disappointing. There were recessions, market corrections, election years, inflation, unexpected world events. Yet, through it all, Jake stayed consistent. His portfolio had grown far beyond what he imagined when he started with just a few $100s each month. The biggest surprise wasn't the money. It was the confidence. Financial stress no longer controlled every decision he made. He wasn't chasing quick riches. He was steadily building lasting wealth. Final message. Your first step starts today. Most people spend years searching for the perfect stock, the perfect market, the perfect time, and while they're searching, time quietly passes. The truth is, building wealth usually isn't about finding a secret. It's about following a simple plan for a long time. Choose a trusted investment platform. Use the right type of account for your circumstances. Build a diversified portfolio. Invest consistently. Review your plan periodically, and let time do the heavy lifting. You don't need thousands of dollars to begin. You don't need to predict tomorrow's headlines. You don't need to be a financial genius. You simply need to start, because the best day to begin investing may have been years ago. The second best day is today. If you found this video valuable, hit the like button, subscribe for more practical personal finance content, and share it with someone who's been waiting for the perfect time to start investing. Thanks for watching, and I'll see you in the next video.